I am so excited to get into some of these subjects much deeper with you. If you're new here, I welcome you to start with the very basics, start at the beginning, and watch the full presentation of how infinite banking works and the problems that we face. But otherwise, I'm going to dig in today into the problems that we're facing as we approach retirement. And I have more and more people come to me that are approaching retirement or just retired, and they're getting really, really worried about a lot of different things. And so I'm going to dig into this today. And I thought it was really fitting just because, like I said, I've had a lot of people come to me lately with the same issues. And so I thought we could be a little bit proactive. And if you are someone who, even if you're very young, even if you're in your 20s, these are things that you want to be cognizant about because you want to make sure that you're planning for your future in the way that's best for you. So I want to share this survey with you that I saw come across my desk, and I thought it was so um, mind-blowing isn't even the right word. Disturbing, I guess. So this survey was done on behalf of the Ontario Healthcare of Ontario Pension Plan. Okay, so it was partnered with Abacus Data. They do these surveys, and I want to just show you some of these highlights here, okay? So nearly 9 in 10 Canadians would choose to pay 9% of their salary with contributions matched by their employer into a defined pension plan in exchange for secure lifetime income in retirement. We're going to look at this a little bit later on, okay? But I want you to look, just kind of remember that 9 in 10 Canadians would prefer a defined benefit pension plan. So let's look at where Canadians are sitting right now. 59% of unretired Canadians think that they will never be able to retire due to their finances. 59%. Most of them are worried about negative impact of inflation. They're worried about housing and affordability, having enough money in retirement, the cost of living. One of the top concerns is Canada-US relations. I'm not going to get political on this one, I promise. So I'll just leave it there. But the cost of living is certainly an issue, economic uncertainty, housing, etc. They're also worried about geopolitical uncertainty, trades, and losing their jobs, retirement savings, and so on. Let's look at home ownership. 50% of unretired Canadians plan to rely on the sale of their home to help fund their retirement. Again, let's table this for a second. We'll come back to it. But half of all Canadians that own homes have to sell their home or they're planning to sell their home to fund their retirement. Now, what about non-homeowners? So if you don't have a home, they're struggling even more. Only 36% of unretired non-homeowners, so people who don't have homes yet, have saved for retirement, compared to 71% of homeowners. Now, it makes sense. These people, if you don't own a home yet, you're probably saving to buy a home. But again, that's putting you farther and farther behind when you look at the long term. Rising cost of rent, of course, is affecting that as well. Now, here's what's interesting. 88% of Canadians, again, would choose to pay 9% of their salary to a pension for a lifetime income in retirement. So here's why this is interesting, guys. So this is super interesting because a defined benefit pension plan is what used to be. Okay, that's what our grandparents retired on. It used to be that you would work for one employer your whole life. You'd climb that corporate ladder. You would get this company benefit plan, and so you knew how much money you were going to make in retirement. It was there for you for life. And then you would have a portion of it that would go to your spouse if you passed away first. Amazing, right? Problem is that's not there anymore. Employers are not offering this. What are they offering instead? Well, we're told to save into our registered accounts. So you have a registered retirement savings plan, an RRSP that you're told to save into from the time that you turn 18 and you're able to contribute to these accounts. You're supposed to put, 10% of your income into these accounts in some kind of savings vessel, whether it's a GIC or mutual funds, stocks, bonds, whatever. You're saving your money there. and that's going to grow. Your employer maybe matches, your employer might contribute some, but now the ownership of that is put on you. Okay, let's look at another key difference here between that and a defined benefit pension plan. So, defined benefit pension plan, again, you were given a specific amount of money that you knew you were going to get in retirement. Now the onus is put on you, the account holder, the person who owns that RRSP. You are now responsible to make that money grow. And so a lot of people are finding when they hit retirement for a variety of reasons, these accounts are not maybe not structured in the way that they thought they were, and they're not getting the returns that they thought they were. Then, and this is where I'm seeing a lot of clients come in, they're coming in when they're just starting retirement and they go, whoa, I had no idea I was going to have to pay this much taxes. No one told them that by putting money in a registered account in their RRSP, that they're not saving taxes. They're deferring taxes, meaning you don't pay on the seed when you make the money, right? You get a little bit of a tax break there, but you're going to take that money out eventually. When you take the money out, you're taxed on that as income. Why is that important? Well, if you had the same account in, let's say that you were invested in, I don't know, Canada Pacific stocks. You have these stocks that you bought when you were 20 and you just keep buying more stocks as you get older. You don't have to pay tax on that until you sell it, right? And when you sell it, you're not paying tax on the whole amount. You're going to pay capital gains tax on 50% of the growth. Now that's debatable. There was a point where the Liberal government said they were going to increase that to 66%. In the end, they didn't, but it's still kind of up in the air. We're going to call it 50% for now. That's a huge difference. Okay, yes, you'll get dinged for part of it, but you're also not taxed until you take the money out, until you actually sell those stocks. Now things work differently. If it's a mutual fund, those are constantly being sold and resold, and you would be taxed on those every year. But again, you would be taxed on the capital gain and not on the full amount like you are with registered accounts. So that's problem number one. We're also told that it's not going to be a problem because once you hit retirement, you're going to be in a lower tax bracket. Now, I don't know who came up with that, but let's think this through for a second. When you retire, do you want to be living on less than you are today? Let's say, even if you have debt or you have a house, so you have a mortgage, whatever, okay, you have expenses today. The theory is that you're not going to have those expenses later on. Guess what? The cost of living is increasing every single year. So as the cost of living increases, you're going to have to take out more and more cash. We also have no idea what taxes are going to do in the future. Judging by the current deficit, they're only going to get higher. That's our history. Taxes have only gone up. So you're betting that taxes are not going to go up and that you're not going to have to take out more money once you retire. Doesn't sound like a great plan. And that's where we have the problem because a lot of people, like I said, are coming to me with this problem, realizing that what they have to take out in order to live, now they have to take out a lot more than they thought because they have to cover that tax bill. Now let's look at what happens after you pass away. And I reviewed this on my Instagram this week. There's a family in Ontario that's blowing the whistle. Oh, did you see that fly? There's a family in Ontario that's blowing the whistle on registered accounts and how they're taxed when you pass away. So in this family, the parents had both worked, classic middle class family. They worked their whole life, saved regularly into their RSPs. They had enough money, so they thought for retirement. They both passed away really young in their early 60s. And one spouse passed away first. Those RSPs got rolled over to the other spouse. There's no taxable event there. The trouble was when the second spouse passed away, now they're taxed that full amount for both people. They're taxed that as income. So that took almost 50% of their cash. So it was about $700,000 that they had. I think it was 715 that they had saved up. Half of that went to the CRA for taxes, for income taxes for that last tax return. That couple thought that their children would get that as their inheritance, and they did not. Problem number one. Problem number two is that couple also had a cottage that, even though they had recently designated it as their primary residence, there were still capital gains that had to be paid on it because it was a vacation home. So on that final tax return, they had to pay the capital gains tax. That now ate about 95% of all of the registered accounts, all of the money that was left to them from their parents that went towards tax. So this family's on the news, the daughter is distraught, and she's sounding the whistle on what can happen here because a lot of people don't realize it. I want you to think about registered accounts again, and I want you to think about what's really happening. So I mentioned before that when you're saving in a registered account, it's like paying tax on not the seed, right? You're paying tax, you get to save tax on the seed, but then you're paying tax on, let's compare it to an apple tree. So you're going to pay tax on the apples as you take withdrawals, right? And by the way, you're not even entirely in control of the withdrawals there because there's a minimum amount that you have to take at a certain age out of your savings, okay? So you're taxed on those apples as you take them off. Then when you pass away, you're taxed on the whole tree. Now, I don't know about you, but I would much prefer to pay tax on just that seed in the very, very beginning and not have to worry about tax later on. There are ways that we can do this, and I'll look at that a little bit later. So again, part of the problem with the registered accounts is like you're going into business with Cousin Ed from National Lampoons. Remember that guy? He rolls up in his trailer um and just kind of squats at their house for a couple weeks. So it's like going into business with him. You have no idea how much you're going to owe him later on. You're taking all the risk, and he's going to get his cut regardless. Okay, that's what we're doing when we're partnering with the government, when we're doing these RRSPs. Again, I'm not saying that they're a terrible product. They can be useful in certain situations. If you are a super high income earner right now and you're sure you're not going to be later on in the future, that might be a good choice for you. Better accounts are TFSA. So you're putting TFSA, you're paying tax on the seed, so the tax-free savings account, but you're not taxed on the growth and you're not taxed when you take money out. Fantastic account, max that out as much as you can. Regular stocks and bonds, yes, you're putting after-tax dollars, so you've paid tax on the seed. You are going to pay some tax when you sell the product. So when you sell your apples, you're going to pay a little bit of tax, but it's not generally as much as you would if you were taxed as income. So again, are we counting on the government? Are we trusting that the government's not going to change the tax rules on us? Are we trusting them to not raise the tax rates over time to be financially responsible? Again, I'll leave that with you, but I just want you to think about it. Registered accounts, they save you tax today, but they're only kicking the can until tomorrow. CRA is going to get their cut regardless. I want to go back to that survey because I want to look at some of the things that people said that they were really concerned about, the challenges that they're facing, right? They're concerned about Canada-US relations. They're concerned about the cost of daily living, inflation, housing affordability, having enough money in retirement. Let's look at what all of these things have in common, right? Losing their job, retirement savings that they didn't save enough. What do they all have in common? Well, they're out of your control. These are things that you can't do anything about. And so, what can you change in your life so that you are not in this position of the 59% that think they'll never be able to retire? So, most of us grew up with the golden rule that if you can save $1 million, you can live off of the growth of that to support your retirement. The truth is that this number is different for everyone. Okay, the first thing that you need to do when you start thinking about retirement planning is you want to think about what you want your retirement to look like. Do you want to travel the world? Do you want to maybe have a business? Do you want to just have passive income and lay on the beach somewhere? Do you want to be permanent cruisers? Whatever it is that you want your retirement to look like, you need to plan that out. And then you need to quantify that. So you need to put dollar amounts on that. And then you need to adjust it for inflation. So that's the first step of really looking at your retirement plan. Next step, when we look at all these things that people are really, really concerned about, we notice that they are things that they don't have control over. Bottom line, you need to get control over as much in your life as you can. You want autonomy. You want control over your accounts. You want control over where your money is going. You do not want to hand this off to someone else. You don't want to blindly hand your money to an advisor at the bank where they're going to put it in mutual funds. Speaking as someone who did it, when I opened my first RRSP, I had no idea what it was invested in. I just checked a couple boxes on the application. They figured out what my risk assessment was and dumped me into an account. I had no idea. This is not something you want to outsource, okay? You want to be invested in things that you understand. You also want to be invested in things that you own and control. Ideally, not a pool of funds. You want something that's tangible. I love real estate. I love physical metals. Some people love crypto. I don't understand it enough to say one way or another. Um, there are tons of stocks, ETFs, things like that that are considered safe or safer, but you want to know where your money's going and what it's doing. You need to understand that. However you're investing, you need to be in the driver's seat of that. Second, start a business. There has never been an easier time to have a business, to make money online. You can literally create money out of thin air. You can be an online coach, you can have digital marketing, you can do any number of things. I guarantee you that you have skills that are marketable that you can be making money with. It's never been easier. Set yourself up so that you will have passive income later on in life. And let's look at passive income for a second. Again, you want to be buying things that are going to be making you money. A lot of us just live through life. We're told to get a degree, get a good job working for a company, climb that corporate ladder, and then you're going to retire. Guys, look at the statistics. It's not working. We need to do better. And the people that are at the top are the people that have taken control. They've built their own empires, they've built their own businesses, they have built their own generational wealth. Okay. And I'm not saying that you have to be born with a silver spoon. I'm saying you have to be smart about how you use your money. Everything you do should be run through the lens of, is this thing that I am purchasing, is this decision that I've made going to make me money? If it's not, is there a way that it can? Let me give you an example. So in my previous job, I was a project manager, and part of that duty was a lot of like shipping and logistic coordination. And I ended up having a ton of returns that were sitting at my house from one of my clients. They were only supposed to be here for a couple weeks. A couple weeks turned into months. Long story short, I had this great big storage unit that was sitting at the end of my driveway that I did not want. It was like a shipping container, ugly, even had graffiti on the side. My husband hated it. It blocked our view. So finally, we said, you know what? We are going to purchase a big shed. We're going to put it at the back of our property where we want it. It's going to look pretty. And we're going to get it bigger than we need so that we have space to store this stuff and we can get rid of this ugly shipping container. Now, the way that we financed that was using our life insurance policies. I'm not going to get into life insurance today. I'm not going to get into how that works. But bottom line is, we used policy loans to fund purchasing that shed. We took the money that my client was paying for storage, we took that as rent, and we used that to fund, like to slowly pay down the loan for the shed. By doing that, we saved that tens of thousands of dollars. We increased our net worth by about $67,000 just by that one decision. That shed flowed money into our pocket. Every single month, it's making us money. Every single loan payment, it's adding into our policy and it's making the policy grow. And that's money that we can use again, rinse and reuse, use the money again to buy something else that's going to make us more money. So another thing that we really want to look at, especially if you're someone who has been doing everything right and you've been saving into your RRSPs your whole life, maybe you have a ton of employer contributions that have also grown this amount. And now you're approaching retirement and you have quite a bit of money sitting there, but you don't know what to do with it. First of all, whoever sold you those should have helped you come up with a plan to use them, okay, to draw down those funds. The worst thing that you can do, in my opinion, is if you want to leave money for your family, okay, if you want to keep that money within your own family or going to your beneficiaries, whoever they are, the absolute worst thing you can do is to live on just the growth. Because if that happens, let's say you have $1 million. You're living on just the growth of that $1 million. $1 million isn't drawing down. That's still your balance every single year. When you and your spouse pass away, now that's going to be taxed as your final income, puts you at the top income bracket because now your income for that year is the full $1 million. That is going to be cut in basically half. Your children are only going to get half of your $1 million, $500,000. That's all they get for all of your hard work that you've put in. So, whatever your plan is, you want to start drawing that down. And that does not mean that you have to take it out and spend it. You can. You have my permission. Spend your money. You worked hard for it. I'm a strong proponent of I don't want money from my parents when they're no longer with us. I don't want that to be a financial gain. But I also know that they don't want the CRA to be the beneficiary of their estate, right? And so here is what I suggest. Part of your plan should be moving your registered accounts. If you're in this position, you want to move some of those accounts, some of that cash every single year into a whole life insurance policy where it's going to grow tax-free. It's still accessible to you and you can access it tax-free. So if you have maybe down years when your investments took a dip, you don't have to take anything out or anything beyond the minimum, I suppose. By putting your money into a life insurance policy, it's going to continue to grow. Okay, you're buying a death benefit that's guaranteed to be paid out. And so the money that you're putting in as premium, that is, is going to go to your children multiplied. If leaving a legacy matters to you, that's what I would suggest you do. Even if it doesn't, you can still take out policy loans. You can borrow against your cash value in your life insurance and use up that cash while you're alive. I go into that in other trainings, so I'm not going to get too much into it today. But that is, to me, the best solution is getting it completely tax-free, getting it out of the tax system. Now, another option is you can start drawing them down, spend the money, of course. You can also buy stocks, real estate, whatever the case is, whatever you're really interested in and whatever you know a lot about. Remember, if you're buying other assets, yes, they're going to be taxed when you pass away. They'll be taxed, there's going to be that capital gains tax. So the difference between what you paid and what it's would be sold for that day, you'll pay tax on half of it. Okay, so if your gain was $200,000, you're going to pay tax on half of it. So you're going to pay income tax on just $100,000 out of that property. Make sense? So another strategy that I looked at recently with some clients of mine was they didn't need a death benefit. They have this money in RSPs that they don't think they're going to need in their lifetime, but they want to move it again out of the tax system so that it's not going to go to the CRA when they pass away. So they're slowly moving it into life insurance, but the policies are not on them. The policies aren't on the parents, they're on the children. So the parents are taking out a smaller policy on each of their kids. They're going to contribute to it for several years, about 10 years. Once they've drawn out down their registered accounts, they don't have to worry about those anymore. They still have access because they're still owners of this life insurance. When they pass away, their children will now become the owners, and those policies will be completely paid up. The kids have an option where they can put more money into them as a savings vessel. They still have access to the cash, but now they're keeping this as essentially it's a family bank. So each child will inherit their own personal banking system. If they don't appreciate that, if they don't understand how that works, you know what? They can cash it in, take the cash value and just cancel the policy, and they still get that cash value that they have available. If they understand how it works, and if you're my client, they will, because we talk about this together. We have family meetings, and I help facilitate that. So if the children understand that, then they're going to keep contributing to these policies as well. They're going to make their systems bigger and bigger so that their kids will then have this windfall of their own family bank. And that's how you keep the generational wealth growing and unfolding and rolling over to the next generation. So, again, just to kind of end off this session, I want you to think about what the plan is for your retirement. One, you need to know how much money you're going to need in retirement and what your plan is to get there. Okay. Take control over as much as you can in your lifetime. Have businesses, keep buying real estate. You want to buy things that you can own, that you can hold, real world assets. Take as much guesswork out as you can. You want to take out the reliance on other outside institutions, and it shouldn't matter what's happening with the Canada US trade deals if you have yourself set. Okay. So that's step two. If you do have registered accounts and you're approaching retirement, you want to make sure that you have a plan to draw those down. What's your plan if one spouse passes away and all of a sudden a really big amount is in one spouse's account? What's your plan for that? Okay, even if you have to pay more tax over a couple of years to get that drawn down, that's still going to give more tax into your kids' hands than it will if you just leave them the registered accounts and let them pay the tax on it. So everything, of course, is an individual decision. And this is something that we look at on a one-on-one basis. And again, I'm not a tax expert. This isn't tax advice. This is my experience. And I just kind of want to give you ideas of how you can move forward and how you want to look at your retirement, how you're going to set up your family for your generational wealth that you want to continue. Because again, we all worked hard through our lives. We want to make sure that that money is going to our own families and not to the CRA to distribute with to whatever they feel the cause of the day is, right? So thank you for watching. Stay tuned for next week because I'm going to go into the numbers of how investments work, how rates of return are calculated, and whether you should really be chasing that great rate of return with the stock market or if there's maybe something better. So stay tuned. We'll talk about that next week.